Hi, I'm Amy Ford, and I'm going to teach you all the basics for accounting for receivables. Now, this is a topic my students often find confusing, so we will walk through all the basics together step by step in this video. We have several topics to cover as we go over the basics for accounting for receivables. Not only will I walk you through all the concepts and rules, but I will also be covering how to prepare journal entries related to receivables. We'll start with discussing the different types of receivables and how the basics of the receivables are going to be recorded. Next, we'll cover some specific items related to accounts receivable. That will include explanation of sales discounts and sales returns and allowances. The hardest topic related to receivables is usually the valuation of accounts receivable. So we'll spend some time going over this concept and we'll do several examples together. Then we're going to wrap up our discussion with specifics related to notes receivable. Receivables are assets. They represent a claim against another party for the receipt of money, goods, or services. The main type of receivable that everyone thinks of when they hear receivables is accounts receivable. Accounts receivable results from transactions with the company's customers. When the company makes a sale to a customer on account, it results in the recording of accounts receivable. Now, on account means the customer did not pay for the goods or services at the time of the sale. Recording the asset, accounts receivable, at the time of the sale goes along with the revenue recognition rule in accrual accounting. Now, you will also hear credit sales to refer to these sales made on account. Now, another way to refer to accounts receivable is to call them trade receivables, as they are the receivables that result from the normal trade or the normal business of the company. Non-trade receivables are from sources other than customers. Now, these other receivables could include a variety of items, such as tax refunds, claims for insurance proceeds, or amounts arising from litigation. These other receivables could also include interest receivable or dividends receivable. Notes receivable are formal credit agreements. Now, we're going to talk about notes receivable in detail a little later. Now, let's review the rules for debits and credits. Receivables are assets. That means debits are going to increase the balance of a receivable. When we initially record the receivable, we're going to debit the receivable. Credits are going to reduce receivables or serve as reductions in the balance of the receivable. Let's walk through how to record accounts receivable. On March 1st, we provide $500 of services to customer A on account. The revenue recognition principle for accrual accounting is that we record the revenue at the time the service is provided. As a result of the transaction, because we have provided the services and the customer has not paid us, we have a receivable from the customer. In other words, the customer owes us $500. This $500 is an asset. Accounts receivable are current assets, which means we expect to collect from the customer in the short term, such as in like 30 to 60 days. To record the accounts receivable, we debit the account, accounts receivable. This is increasing the asset, accounts receivable. To record the revenue, we are crediting the account, service revenue. On March 10th, customer A pays $200 on account. Now, this time on account is referring to the services that we previously provided on March 1st. But wait a second. On March 1st, we provided $500 of services. Did customer A pay the entire amount that they owed us? No. Is that okay? Yes, it's okay. That happens all the time in the normal course of business. We'll record the $200 that the customer pays on March 10th. We receive cash from the customer. To increase cash for the amount we're receiving, we debit the cash account. When the customer pays us, that is going to reduce our asset, accounts receivable. How do we make accounts receivable go down? With a credit. So for this transaction, we will credit accounts receivable $200 to reduce the balance of the asset by $200. But what about the amount they still owe us? Don't worry, I haven't forgotten about that. Let's review the accounting cycle. In the accounting cycle, we record transactions in the journal. Then we post to the T account. Here's our T account for accounts receivable for the month of March. On March 1st, we post the debit entry of $500. Remember, that's when we provided the services to the customer on account. Then on March 10th, we post the credit entry of $200. That is the $200 the customer paid on March 10th. Now, in our simple example here, this is the only customer that we have so far. So at the end of March, the balance of accounts receivable is a $300 debit balance. To find the balance of an account, you add up all the debits and add up all the credits. You find the difference between the total debits and the total credits, which is your ending balance. Now, whichever number is bigger is the side of that balance. So here, our total debits are $500 and the total credits are $200. The difference is $300. The balance is on the debit side as the debits are greater than the credits. As of March 31st, our company has $300 of accounts receivable. Let's say that the customer pays the $300 balance on April 2nd. Then we would record the entry in the journal on April 2nd. Is what we've covered so far giving you a better understanding of receivables? I sure hope so. If you want to learn more about how to record sales discounts, the allowance for uncollectible accounts, and how to record bad debt expense, then click the link below or go to Gleim.com and look for our free basic accounting course in the CPA free resources section. In the course, you'll find great information on other topics, such as all the details on how to record inventory and liabilities, which can really help you in your financial accounting classes. So click below or go to Gleim.com to learn more.